What's up, guys? Welcome back to the Easily Profit YouTube channel. Now, in today's video, I want to jump straight into it. This is going to be one of the easiest strategies that I have to just jump into the market, start making some money, and start playing these stocks. Now, it's the summertime. The summertime is always pretty hot in the markets, especially small caps, penny stocks, and you have all these meme stocks blowing up right now. So you don't want to just, if you just are new to the markets, you don't want to just jump in and start buying anything. I want to show you what to look for, how to trade these, entries and exits, and just pretty much everything explained. Go out there, go make some money, pay off debts, whatever you got to do. We're all here for just to make money anyway, so might as well show you guys how to do it. Free and easy. Might as well drop a like if you love these type of videos, subscribe to the channel. Let's jump right into it. So let's just jump straight into everything. Time is valuable. Let's just go everything. So it's going to be entries, exits, the setup, what you need to be looking for, all of this. So the three things that you need to focus on, number one is going to be, what are the important levels during the day that you need to be able to reference on every stock? There's specific levels that I'm going to go into. Number two, knowing where the traps are. So this is going to be able to identify when things are going to go against you and not how to panic, and knowing whenever there's a true breakdown versus some form of trap that can actually help propel the stock. Traps happen in both areas, bull traps, bear traps. And then number three, where you should target entry and being able to associate, well, not really associate, but being able to assess risk actively in the trade. That's one of the most overlooked aspects when it comes to trades, is whenever you're seeing a possible opportunity, how to know if this is actually going to be a very risky opportunity or this is something going to be on the lower risk side. Certain areas, certain indicators that I'm looking at to associate risk with the time that I'm looking to enter into the trade. So let's just break it down from the beginning. So when it comes to every opportunity that I look at, any stock that may be a gap up, let's say, for example, GTT this week was a very nice gap up play. The funny thing is, this one ended up having no news on it. If you can read the news report, it says GTT Communications shares are trading higher, abnormal high volume, not seeing any company specific news. Now, this is a red flag. This is a red flag in the area that we don't know specifically any type of news that is running the price, but a lot of times this is going to be some form of sympathy pump based on another different company. You can see this, especially with meme stocks like AMC, GameStop running up. A lot of times there's just hype in a certain area. People are attracted to it, and it's going to cause these companies to run. So just because it doesn't have news doesn't mean it isn't going to run, but you still want to have that red flag there where you're going to associate this with something that's going to be very short term. You're not going to be looking at it as any type of long term play. So anything like this, I'm not looking to swing. I'm not looking to invest. I'm not looking to hold long term. I'm literally just looking to play the quick movement in and out. I'm gone. So that out the way, the first area you need to focus on is situational awareness, knowing where the important levels are. On every stock that I look at, there's three specific levels. The first level is opening price. Second level is going to be pre-market high. Third level is going to be psychological point. So explained, first level, opening price. If you want to look at the opening price of a stock, there's two ways to do it. If I look at GTT under a microscope, not really a microscope, but looking at GTT under the daily chart spectrum, I can see the move that catapulted this stock. There was a very, very large green day, ends up gapping up overnight, and this is the morning that we are looking at right now. Now, if you understand candlestick creation, you'll know that the bottom of a green candle, the body is the open, the top of the body is the close, and with the red candle is opposite. So the top of the body is the open and the bottom of the body is the close. So you don't get the opening price not until the stock actually opens on the day. Once that 9:30 Eastern time hits, that's when you finally get to see the opening price. So here, it would be right at this level right here. So if I draw that, it's going to actually shoot this line all the way across the charts. Very, very simple, very, very useful. Second level that I look at is going to be pre-market high. So if you see like any type of highest point, I sometimes don't like to account for the wicks. I like to account for the body of the candles. So I would look at this point as a pre-market high, and that is going to be able to be drawn across. You can do this before the market even opens. A lot of times, most of the pre-market highs are set very early in the pre-market. So you can do this even before the day even opens. And then number three is going to be psychological points. So what are psychological levels? Psychological points are going to be areas that natural selling does develop at those points. So this will sometimes be whole numbers, and that's going to be the most common psychological level, is going to be whole number points. So if we're looking at like a level, like let's say, for example, 4 is going to be a psychological point. 5 is going to be a psychological point, for example. So whenever stocks lead up to these levels or pull back to these points, sometimes you're going to find that there is going to be some support that tends to develop at these levels. Look at here, whenever this company ends up pulling back, ends up bouncing off a 4 before going to the next highest level. Sometimes they'll pull back beforehand as in anticipation to that point. It's not perfect, but it's still something that is worthy of note. So playing this around and looking at this in detail, now I get to develop a range, the range of what I'm willing to play. So my range that I like to stay within, and this is going to be key that you're going to be able to use this summer when the markets are hot, things are going to be popping. The range that you want to use is going to be from the opening price to the pre-market high. Most companies are going to open below the pre-market high. So this is going to leave a lot of space open to be able to run. What you're going to see 90% of the time is companies are going to end up rejecting whenever they reach those pre-market highs. You're always going to see this action. I guarantee you 70, 80, 90% of the time, a lot of these runners out of the gate that start to take off, you're going to see some form of rejection here. Can it break past this rejection? Sometimes it does, but you have to expect rejection here and you have to be able to sell before you reach these points. So this is one of my rules. My target can never be above the pre-market high. So if I'm trading below this point within this range, I can't look to buy on a run and look to set a sell target at 448. My maximum target can only be 440 or less. So by doing that, I always decrease the amount of chance of that me overshooting the target and never selling beforehand. You'll see this in a multitude of different companies. Let's say if we go back to AMC, you'll see that as well. So now I have a range set for this company here that I'm looking to trade within. The bottom side of this range, whenever companies go red on the day, I'm not enticed to buy anywhere below this range because this is a lot of times a very easy trap that a lot of people fall into because we look at stocks in very simplistic terms of cheap and expensive. Oh, it's cheaper down here, so which means more profit if it goes in my direction. But down here, typically once you go red on the day, number one, a lot of the volume starts to dry up. And then number two, short sellers see that as a cheap and easy opportunity. So it doesn't really grow as quick as they want to. Now, if they do go red on the day, for example, let's say, out of the gate, it does drop, and then it finds support and starts to work its way back up, then you have a possible red to green move, which is like a short trap. So this can accelerate the movement later on to actually have a very, very large growth. But I'm not just going to buy it as it's going red on the day just because it's cheap. That's one of the biggest mistakes I see a lot of people make as well. So now that you have the range, second thing is identifying the trap. So who are you trying to trap? That's the biggest question here. So if you're long bias, the majority of everybody here is going to be long bias. I find that a lot of people go short bias because sometimes short selling seems easier because we find more companies that gap up and crash than we find that gap up and continue to run. So by logic, you would say, well, since more of them crash, I probably would be more successful if all I do is short. There may be some merit to that. But the fact is, there's a lot of instances where we see that it looks like a short opportunity and it completely explodes. Look at GameStop, look at AMC, a lot of the meme stocks for a perfect example. People think, oh, this is the end of the run, blah, blah, blah. They keep on running, and they just destroy short sellers' accounts. So the fact is, you have to identify the trap of a short seller. Where would a short seller get trapped at? So what I identify as a trap is some form of failed shift of momentum. So the perfect example of a trap would be something like this, where you'll see a run out of the gate. Remember, one of my rules, don't trade within the first 5 minutes. So all of this price action develops out of the gate. I'm not mute to it. I'm watching it, but I'm not going to be very, very on top of it trying to buy into it just yet. Now you have a very, very strong red candle that pulls back. This is going to scare a lot of people out. This is going to scare out a lot of the weak hands. I actually like to see pullbacks in the morning because number one, takes out a lot of the weak hands and it sets up a lot of traps. A lot of traps are started or begun with a very, very sharp red candle to the downside. Once I see this, that trap is beginning. Now, once it pulls back, you're still seeing that it is being supported by the opening price. The opening price is still some form of level here that is being referenced. The reason I can see that is being referenced is there's really no true full-bodied candle below this point. I don't like to look at wicks as definitive breaks. That's a big mistake that you can make, and I made that early on as well. Don't look at wicks. If the wick is, if the body goes below this point and before the end of that candle, it comes right back up, it is not broken. It is not below that level. These wicks can sometimes steer you in the wrong direction. I can still see that support is being maintained at the opening price. What happens at this point is if anybody that has been shorting this as an opportunity saying, okay, it's peaking, now it's looking to go down, let me look to short, let me look to bet against it. Now they're stagnant. There's no other downside movement that is developing, and now it's starting to work its way up. Once you start to see it work its way up, and what I also like to do is overlay volume on top of that as well. Let me go back to the chart. It's much more clear. When you start to see that volume starts to increase after that downwards move, that shows that I coincide volume with people's confidence. Remember, if I'm confident in a position, what is the next action I'm going to do? Most likely, I'm going to click a button that says buy or short sell or whatever. So if people are confident, action is going to start to happen. And as people buy shares, the volume is going to grow. So if I'm seeing growth in volume after some form of large downtrend, that shows me that people are looking at some form of cheap opportunity to look to buy into. And now it's starting to push towards the high of the day. So at that point, I see this as a successful trap, maybe a bear trap or a short trap, whatever you want to call it. I see this as a successful trap that now will start to run to the next level at that point. So this is identifying the trap. The trap is going to be something that looks just like this. Very flash crash, sharp crash, people buy the cheap opportunity, and then now it looks to work its way up back to the high of the day. If you put this below here, this is pretty much just going to be a red to green move. But sometimes red to green moves don't always happen. Sometimes some companies will run out of the gate, and then now you have the company only staying green on the day and doing a setup like this. It's the same setup, but just depends on where it starts at. It may start below the opening price, maybe a red to green move, or it can start above this point and just being a simple trap. Now, thirdly is where do you identify the entry points? Where do you look to take the trade? All of that can be explained whenever you now overlay indicators onto the charts. I don't trade naked charts. I like to look at naked charts in the morning so I can purely focus on opening prices and pre-market highs. You can see that if you trade sometimes naked charts, you can detail fairly closely where levels should be rejected and should be pulled back. RSI isn't going to tell you that, okay, it's going to pull back at 440 or it's going to look to bounce at this point. It's not that clear. But if I use studies, let's say, for example, one of my favorite ones to use is volume weighted average price, or VWAP. This comes into play where I look at the middle level of the VWAP, very importantly, as just like how I would look at the opening price, being below the opening price, not really interested, above the opening price, something within a good range. It is more bullish than bearish and has positive attributes. Now, this becomes important once you identify a trap, saying, okay, the trap is set, people are taking the bait, people are buying the cheap opportunity, and it's starting to grow. From there, then you want to target entry. I like to target entry as close to the VWAP as possible. That is very vague in a certain sense, because what is close? Is this close? Is this close? Is this close? I mean, there's a lot of different interpretations to that. But what you're going to find is, rather than looking for close, you should look for within your risk level, or within your comfortable risk level. So the way that you're going to look to derive that is, once you see that trap has been set, then you're going to see any type of, for example, the upwards trending in the volume, you're seeing confidence is growing. Once you can click it in your brain and say, okay, this is a push, this is a squeeze, this is the trap working. Then from that point, then at that time that you see whatever candle you're looking at or whatever setup you're looking at, you're going to look to measure distance between VWAP and current price. So if I look at VWAP to current price, let's say at this moment, VWAP to current price, let's say if the current price was in the middle of this candle as it's being created, is right around 7% worth of distance to the downside. So if I was to buy the stock at this point in time, I have to be open to some form of pullback back to the VWAP. It can happen in certain instances. And remember, if that happens, I'm going to be down 7%. Does that mean that the company is garbage at that point? No, because as long as it still maintains above the VWAP, there is still a more likely bullish scenario than bearish. So this is the problem when a lot of people run into is, if you don't look at VWAP or you don't account the VWAP into any trade, you're going to have instances where you buy 10% above the VWAP. It gets closer back to the VWAP as it looks to pull back. Maybe it's too overpriced for that time. You're looking at this downward situation. You sell because you're now a weak hand. Remember, look at this setup here, the same exact thing. You're now a weak hand. Oh, damn, I'm down 7%. Let me look to jump out. I need to protect myself. You do that, and then you miss out on the run. You don't want to become part, you don't want to be trapped. You want to be able to exploit the trap. So to be able to exploit the trap, you have to always stay within a very, very lower risk tolerance. Let's say, for example, for the sake of this example, this is a lower price company. So let's say within 2% of that range, which means that once I identify this trap, I'm going to look to target entries within 2% of this VWAP. So you can see that it doesn't happen very, very often. Certain times, once a company runs, you're not going to get a viable entry maybe for the remainder of the run. So you can see that once you identify the trap, you may only have 1 or 2 minutes worth of opportunity to grab cheap shares before it bounces and it keeps on going. So if this is my range of risk that I'm willing to go within, anything above this is too risky. You can see that the opportunities may be very, very small. So it's very, very specific that you look at this, and as experience develops, as you are more as you stay in front of the computer, you trade. If you're live trading or if you're paper trading, the more you trade, especially the easier it is for you to identify traps earlier and earlier and being able to grab those positions before they balloon out of proportion. And now you're not able to grab them within a very, very nice range between the VWAP. So that's all it really is. So in conclusion, this is going to be the strategy that I'm using currently, and I'm probably going to be using this all the way throughout the summer. So this summer is going to be pretty hot. Don't wait. Jump into the markets, learn how to trade, start making some money. I mean, money is flying everywhere. Might as well grab it. So if there's any little things that don't make any sense here, put them in the comments down below. I'll definitely clarify. You guys have my contact information. Any little help you guys need, I'm always going to be right here. So it's Easily Profit again. Another video. I'm going to come out with more videos pretty soon. Hope you guys enjoy. Take care.